It's a new month here at Henssler Financial, and we found 3 important things to focus on in the market this month. Number 1, the banks. Well, unless you've been living under a rock lately, you're keenly aware that in recent weeks, 2 U.S. banks have failed. Just days before the March 10th takeover by the FDIC, Silicon Valley Bank was believed to be a well-capitalized institution who was looking to raise funds. But just 48 hours later, a panic-induced run on the bank by its large venture capital depositors, Silicon Valley Bank had become the second largest bank failure in U.S. history as more than $42 billion in deposits headed for the doors. That wasn't the end of bank troubles, however, as Signature Bank, a New York-based regional bank who was a leader in cryptocurrency lending, suffered a very similar fate, becoming the third largest bank failure in U.S. history just 2 short days later. While things seem to have calmed down for now, thanks in part to the Federal Reserve's action to provide an emergency lending facility to banks, we're not out of the woods yet. Economists broadly believe that while a full-blown financial crisis isn't likely in the aftermath of those 2 large bank failures, the risks to global growth have certainly risen as tightening credit conditions are likely. The immediate risk going forward is that banks in the U.S. tighten their willingness to lend to American households and businesses to ensure their own balance sheets stay healthy. A slowdown in U.S. lending could squeeze global growth by hindering demand for other countries' goods and services. More broadly, global trade and the financial system are underpinned by the U.S. dollar. That means tighter U.S. financial conditions, such as less lending, higher borrowing costs, and lower prices for stocks and other assets, can quickly spread to other economies. Number 2, earnings season. With the first quarter now in the rearview mirror, companies are set to begin reporting their first quarter results. Sales for S&P 500 companies are forecasted to have grown 1.6%. However, Wall Street is forecasting earnings to be down 5.2% in the first quarter of 2023, which would mark the steepest earnings decline since the second quarter of 2020, when the onset of the COVID-19 pandemic sent profits plunging 32%. If you exclude energy sector earnings, this number falls further to 6.7%. From a sector view, consumer discretionary stocks are expected to post the biggest increase in earnings at 36.5%, followed by industrials and energy at 17.1% and 13.7% respectively. On the other side, materials earnings are expected to fall 32.9% as commodity prices have come back down to earth, while both healthcare and tech are also expected to post large earnings declines at 18.9% and 14.4% respectively. It's evident in these estimates that companies are facing economic challenges lately, including inflation and rising interest rates, and more recently, concerns over the health of the financial system. A core question for investors is just how long customers can continue stomaching higher prices as companies try to pass on elevated costs. The answer to this question is sure to dictate stock prices in the coming weeks and months. Number 3, inflation. We know you're tired of it, but with the March jobs report behind us, the market will again turn its focus to inflation ahead of the May FOMC meeting. Inflation continues to moderate, and street expectations for the March CPI and PPI reports suggest more of the same. After rising 6% year-over-year in February, economists forecast that year-over-year growth in CPI further moderated to 5.3%. Excluding the traditionally volatile food and energy components, this number actually rises to 5.5% as falling oil prices have benefited consumers as of late. The Producer Price Index is likely to show more of the same, with year-over-year increase in prices paid by producers forecasted to fall 3.5% from a previously reported 4.4%. So why do we care about this inflationary data? Well, for starters, it suggests the trend of prices that we as consumers pay is on the decline. But in the context of financial markets and the Fed, the more rapid the decline in inflation, the more likely the Fed will either slow its rate hikes or pause them altogether. Financial markets, however, don't believe we're there yet, as at the time of this writing, CME data suggests a nearly 70% chance of another 25 basis point hike to the Fed funds rate at the committee's May meeting. Now, plenty can happen in the next month to change that, so we'll continue to watch the data closely. And that's been your Market Minute for the month of April. Thanks for listening.